Your customer is always your best investor. Taking VC money when your business is not VC shaped, it doesn't give a neutral outcome. It's important to know that crowdfunding is not passive. The campaigns that fail are the ones that expected the platform to drive discovery. It doesn't work that way. Before you pursue venture capital, ask yourself honestly, is my business one that could plausibly be acquired for 100 million or more within 7 to 10 years? Every type of capital has a real cost. Equity is just a small part of it. Hi, my name is Adenike, and this is Everything Funding. I'm an investor who has deployed over $10 million to more than 100 startups, and I'm on a mission to help women-led consumer businesses raise the funding that they need to scale their ventures. In the last video, I covered 5 ways to fund a consumer brand: grants, debt, revenue-based financing, angel investors, and accelerators. If you have not watched that one yet, start there. The link is in the description box below. In this video, we are covering the 5 routes most founders never even consider or don't know enough about. And then I'm going to walk you through exactly how to choose between all of them. Let's get into it. The 6th option is equity crowdfunding. Let me explain what that means first. Equity crowdfunding is where you raise capital from a large number of individual investors, often hundreds or thousands of regular people, each putting in a relatively small amount in exchange for a small ownership stake in your business. It is regulated in most markets, which means you raise through a licensed platform rather than going directly to the public yourself. And it's important to know that the regulation matters a lot. Solicitation rules apply. You can't just post on social media asking people to invest in your business. That is likely illegal in most jurisdictions, except when you're sharing a link to the crowdfunding platform you're raising with. That's fine. Everything you do when it comes to equity crowdfunding has to happen through a regulated platform. And there are rules about what you can and cannot say publicly during a live campaign. Before you run an equity crowdfunding campaign, you need to understand the rules in your market. The platform you choose will walk you through this and tell you what you need to know. It's important for you to know that there are guidelines and guardrails. For consumer brands specifically, this route is more powerful than most people give it credit for. I want to help you understand it. Equity crowdfunding is not a fallback for founders who can't raise properly or don't have access to institutional investors. It's the right first choice for most consumer brands, and this is why. Your customer is always your best investor. The people backing consumer brands on equity crowdfunding platforms are not faceless institutions. They are people who actually care about what you're building. They love the products that you are selling. And when they invest, they become advocates with a financial stake in your success. They share your products, they review it, they tell their friends about it, they post about it on their social media. So you're not just getting capital from them, you're also getting distribution. You get to build your investor base and your customer base at the same time. A crowdfunding campaign is also a marketing event if you run it well. By the time you close your campaign, you would have social proof that a pitch deck can manufacture for you. When you walk into investor conversations after running a successful campaign, saying, oh, we raised from 800 investors or 1,000 investors who are also our customers, it's a game changer. The investors know that you have a strong base of people who not only buy your products, but love it so much that they invested in it. Sienna Sauce, a Black-owned food brand founded by then-teenager Tyler Simone Creighton, raised from over 1,400 investors on Republic, exceeding her target by nearly 800%. Black Mama Teas raised over $2 million on WeFunder. In the UK, peanut butter brand Peep and Nut raised their first round on Crowdcube. Ruka Hair, a Black-founded brand building ethical hair extensions for Black women, raised on Crowdcube before going on to secure strategic investments. These are consumer brands whose communities believed in what they were building and supported them by investing. Important platforms to know are Crowdcube and Republic Europe for the UK and European founders, Republic and WeFounder in the US. Most major markets now have at least one regulated equity crowdfunding platform. Look for what is available in your country. Before you get excited, it's important to know that crowdfunding is not passive. The campaigns that fail are the ones that expected the platform to drive discovery. It doesn't work that way. You have to bring the crowd. If you have a solid community, you already have a head start. The platform provides the infrastructure for you, but you need to expect that you're going to bring 30 to 40% of your target from your own network before the campaign goes live. If your network is not that large yet, the campaign might stall. I'm going to do a full video on how to run a crowdfunding campaign as a consumer brand. We'll be covering everything from how to build the audience before you launch, to how to structure the campaign, to what happens after you close. Equity crowdfunding is right for you if you have a strong community around your brand and that is deeply engaged and you are at seed stage or beyond. The seventh option is family offices and patient capital. Family offices are private wealth management vehicles for high net worth families. They exist in every major market globally. They often invest in consumer brands and they operate with more flexibility than institutional VCs. And most importantly, they are not under the same return pressure. Let me explain. A VC fund has a 10-year life cycle. They need to return the fund within that window. That means they need to return the money they have raised, ideally with lots of profit, to the people who gave them the money to invest. That creates pressure for fast growth, aggressive scaling, and a relatively quick exit. A family office is investing generational capital. They are investing their own money. Their horizon is often longer and they can be patient with a brand that takes years to build correctly. For consumer brands that want to go through community and authenticity rather than paid acquisition and hypergrowth, patient capital is often a better structural fit than institutional VC. The growth story matches the capital. You're not being pushed to scale before you're ready. The challenge is that family offices are harder to find than VCs. They are less visible by design. The routes in are typically through warm introductions from your angel network, from high net worth individuals you may know, from advisors, from professional service firms that also service these high net worth clients. And even when you find one or get an introduction, the process can be quite slow. They have to like you. They have to connect with what you're building. Your values have to align. There's no fund mandate driving urgency. Decisions can take months. The terms can also be very unusual. Family offices don't always follow standard deal terms. So whatever you agree to needs careful legal review before you sign. Make sure you know what you're getting into. Now, this route is one that most founders don't explore because they know it exists, but they are not sure how to go about it. Family offices are right for you if you're building a brand with long-term equity as the primary value driver and you rather grow correctly than grow fast. The eighth option is strategic investors. A strategic investor is a corporate that invests in your business because they want access to what you've built, your community, your supply chain, your category expertise, your brand. In consumer, this means the major players. Think Unilever, L'Oreal, Estee Lauder, Pernod Ricard. These are global companies with active investment arms, specifically looking for brands like yours. They are not just writing checks. They want access to what you have built. The real upside is not just the capital. A strategic investor often unlocks distribution that you would otherwise spend years building. A check from a major consumer group can open a retail conversation that few venture capitalists can open for you. Ruka Hair, the Black-founded brand building ethical hair extensions that I spoke about earlier. did equity fundraising, raised from angels and VCs for their pre-seed round, and then secured strategic investment from Henkel Ventures, one of the world's biggest consumer groups. They built community first, they were backed by their community, then they were backed by strategic corporates. Lift Tinted, the inclusive beauty brand, received investment from both Unilever Ventures and L'Oreal's fund in the same round. These are consumer brands where the strategic investor saw not just a product, but a community and a cultural moment worth backing. The trade-off here is that strategic investors have interest beyond financial return. They may want exclusivity, first right of refusal on acquisition offers, which means that they get to decide who buys your company, or they have inputs into product decisions. These terms need to be read carefully with a lawyer who has seen these deals before you sign the agreement. If distribution is what you really need right now, and your brand is something a larger player would really want to own, strategic investment from a corporate is worth going for. This funding route is right for you if you have a proven brand, your distribution is your primary constraint, and you're open to a partner with a strategic agenda alongside a financial one. The ninth option is private equity. Private equity is different from venture capital. Venture capital invests early, takes a minority stake, and bets on growth. Private equity typically invests later, often takes a majority of significant stake, and brings operational expertise alongside capital. They are buying into something that already works and helping it scale. So typically, you have your foundation and then they just help you expand, enter into different markets, and really take things further. In consumer, private equity is a serious and well-established category. TSG Consumer Partners in the US are built specifically to back consumer brands at scale. They understand your model, your metrics, and retail dynamics in a way generalist investors often do not. Beyond the well-known names like TSG Capital, there are smaller mid-market PE funds that back consumer brands at earlier points in their journey. These are usually a better fit if you're just starting out than the big names. It's important to note that PE is later stage. They want to see established revenue, strong unit economics, and a brand with real equity. This is not usually where you start if you're just building. It's where you go when you've already established things and you need fuel to really take things further. But it's worth knowing about now because it's where many consumer brands that you admire have ended up. And understanding what private equity looks for changes how you build from the beginning. If your goal is to build something worth hundreds of millions, private equity is likely in your future. The decisions you make today should reflect that that's what you're aiming for. There's also a smaller but growing category worth knowing about: search funds. These are individuals who raise capital specifically to find and acquire a single business, then run it themselves. They are increasingly looking at consumer brands, so it's worth knowing that this option exists in case you've built something and you're ready to sell it to someone and, go on with your life. Private equity is right for you if you have significant established revenue, strong unit economics, and you're ready to bring in a partner who will take an active role in scaling the business. I'm talking about venture capital last deliberately, not because it's the worst option. For the right business at the right stage, venture capital is the right answer. I'm talking about it last because it's the most demanding, the most talked about, the most popular, and the most misunderstood. I wanted you to hear it after we've talked about all the other options. Here's the honest breakdown of how venture capital works. A VC fund raises money from institutional investors, such as pension funds, endowments, family offices, and promises to return that money plus a significant multiple within 10 years. To do that, they need their portfolio companies to grow very fast and either exit via acquisition or IPO. That model works for some consumer businesses, the ones with a genuine path to a very large exit within a reasonable time frame. It doesn't work for every consumer brand. VC does not validate your business. It doesn't define your business. It's just one funding route. It's not a badge of honor. It's just a funding source. A brand that grows to 20 million in revenue over 10 years and returns phenomenally for its founders may never return a VC fund. Not because it's a bad business, but because it's the wrong shape for that capital structure. Taking VC money when your business is not VC shaped, it doesn't give a neutral outcome. It creates pressure for growth at a pace your model may not support. I've watched many good businesses get damaged by taking the wrong capital. Money is good, but you need to remember that there is always a cost. This is part of why you keep hearing no for some rooms. Sometimes it's bias, and yes, bias is real. It's structural, and it specifically affects women building consumer brands in ways that go beyond individual investor prejudice. We're going to have a full conversation about that, the structural barriers, what they are, why they exist, and specifically how you can navigate them. Venture capital does work for some consumer brands, the ones that are genuinely built for speed. Topicals, the skincare brand, raised VC after tripling revenue in a year. Glossier built a community-first beauty brand into a VC-backed global name. These are consumer brands where the growth trajectory matched what VC needed. If yours does too, then VC might be right for you. Before you pursue venture capital, ask yourself honestly, is my business one that could plausibly be acquired for 100 million or more within 7 to 10 years? If the honest answer is yes, VC can be the right partner. If the answer is uncertain, some of the other routes on this list deserve serious exploration from you first. Venture capital is right for you if you have genuine hypergrowth potential, a credible path to a large exit, and you're ready for the governance and reporting that institutional capital demands. So, how do you know which one or which combination is right for you right now? 3 questions you need to ask yourself. The first one, what does this capital actually need to do? If you need to fund production or a marketing push and you already have revenue, debt or revenue-based financing is good. If you need to build credibility and open investor doors, angels or an accelerator might be the right choice. If you need to unlock distribution as much as you need capital, then try getting strategic investors. If you want to turn your community into co-owners or leverage your existing community, you can try crowdfunding. If you want to fund a development phase without diluting, take grants. If you want to scale something that is already profitable and proven, then private equity. The second question to ask yourself, what are you actually willing to give up? Aside from equity, you need to think about your time, your autonomy, your reporting burden. Grants ask for reporting. Accelerators ask for months of your attention. Strategic investors sometimes ask for exclusivity. Private equity often takes majority control. VC asks for growth at a pace and scale that may or may not match what you're building. Every type of capital has a real cost. Equity is just a small part of it. The third question to ask yourself, what stage are you at? This is the most important one, and it's the one most founders are least honest with themselves about. I'm not asking you where you want to be or where you tell people you are. I'm asking you where you actually are right now, at this very moment. What is your revenue like? What is your repeat purchase like? What is your retention rate? What traction do you have? Because the right capital changes completely depending on what your answers to these questions are. So you need to know exactly where you are and then find the route that matches it. One more thing to note. Most consumer brand founders end up using more than one of these routes. They use grants to fund development before they give ownership in their business to anyone. They use crowdfunding to build proof of community before they approach angels. They use revenue-based financing to hit retail milestones. Then equity investors from a position of strength. I've also seen companies raise via crowdfunding alongside an angel or VC raise. It all depends on what your goals are and what you're trying to achieve. So, there you have it. Grants, debts, revenue-based financing, angels, accelerators, crowdfunding, family offices, strategic investors, private equity, venture capital. Most consumer brand founders are right for more than one of these. Very few need venture capital to build something extraordinary. Here's what I want you to do after this video. Write down which 2 or 3 of these feel most aligned to where your business actually is right now. Not where you want it to be, where it is. Because over the course of this series, we're going to go deep on the ones that matter most for consumer brands. Crowdfunding from start to finish. We'll explore how angel investing works and how to find the ones who actually back businesses like yours. We'll talk about how private equity works when you're ready for it. We'll talk about what VC investors are really looking for when they look at a consumer brand. We'll talk about how to negotiate the terms that matter. And we'll talk about the structural barriers that female founders face and how to navigate them. Every video in this series is a tool. If you haven't subscribed yet, please do it now. Honestly, trust me, you don't want to miss one of these. And if you know someone who is building a consumer brand and trying to figure out the funding piece, please send this to them. That's exactly who I built it for. In the next video, we're talking about what investor readiness actually means for a consumer brand. Not the broad or generic version. I'm going to go deep. We'll be talking about the metrics you actually need, what your story needs to look like, the proof points that make investors say yes instead of maybe. I hope to see you there. Please leave a comment with any questions you have about any of these funding options. Thank you so much for watching.